Another day in a rather unique and somewhat strange market. There's very interesting signs coming through for us to analyze and take a look at and see where this market might be going from here. We've obviously had a massive run in mega cap tech. However, that's not necessarily the same for the rest of the market, with less than half of all S&P 500 stocks above their 200-day moving average. So for many stocks, a downtrend is in place. However, obviously, for a select few, that downtrend is non-existent. We're talking about Microsoft and Apple in particular, the two biggest stocks in the stock market. They are contributing massively to the S&P 500 gains, in addition to stocks like Nvidia. However, the economic trend isn't very different between these stocks and the rest of the market. In some cases, in Nvidia's case, it's actually worse than the rest of the market. So why are these stocks seeing such tremendous outperformance? Apple obviously engages in a buyback. However, the effects of that buyback are highly questionable because they take on debt to finance that buyback. I don't know if you saw, but they just today offered debt into the market. Seems rather strange for that to have an impact. You're adding a liability to the company and you're using that liability to purchase stock. You would think that has a net zero impact, especially because in theory that stock can be sold. Now, I get it. Apple's not necessarily in position to sell stock, but Nvidia is. Nvidia is actually selling stock. They're not buying back their stock. So, in my opinion, the buybacks alone can't explain why there's such a divergence between just a few very large and very expensive stocks and the rest of the market. In my opinion, this can't go on very long. And I think we're starting to see signs of that. Some mega cap tech stocks today performed rather strong. Google performed rather strong. That's strange because Google didn't have such wonderful earnings. Yes, they were up initially on the report, but by the time the market opened the next day, they were actually down. That was because they made some strange accounting changes to beat that estimate. But those accounting changes weren't factored into the estimate, so when you adjust for those, they actually missed earnings. Google is a very economically sensitive company, and economically sensitive stocks are doing quite poorly so far this year. You look at the Russell 2000, there's definitely a lot of banks in there, but there's a lot of other economically sensitive stocks, and those are quite weak. Now, all of mega cap tech seems to be economically sensitive. Microsoft, yes, they're still growing, but their growth rates have come down dramatically, particularly in Azure, their cloud service, which is the most important part of their growth engine. That is what's driving the double-digit growth for Microsoft. That experienced some 20% growth last quarter and the quarter before. That is a major deceleration from where it was, but it's still up there. Amazon also guided to less than stellar and continuing to decrease growth in their AWS cloud. That's impacting their stock. Apple has had 2 and is now guiding for 3 consecutive quarters of declining growth. I'm not sure if that's happened at least in the last decade, possibly another decade behind that. So I'm not sure, but definitely an environment that is highly questionable. Now, Apple has had double-digit and 50% plus drawdowns, and it's not that in the last few years this stock became a revolutionary, out-of-nowhere growth company. This company has always been, for the last several decades, a company that has been large, producing computers for consumers, having a rather large and notable market share in the PC, iPod, etc. market. So they've been producing products that customers love. They've always had this strong cult following of very loyal customers. But for some reason, the market is deciding to act differently. So I don't think this acting differently is warranted. I think these very few stocks, particularly Nvidia, which has tremendous economic deterioration, they have very high inventory levels, they have declining revenue, declining earnings, and are selling stock into the market, I think that this mean will eventually reverse, meaning that it will get back to what everybody else, what every other stock seems to be doing, particularly the more economically sensitive stocks. These stocks are not economically impervious. We are absolutely seeing that. That is objectively true. That is what's happening in their business. Even Meta, that was up tremendously on earnings, Mark Zuckerberg said we're going to experience an economic situation like we haven't seen for a very long time, and it's going to go on for a very long time. The stock is obviously well off its highs. I'm not necessarily including Meta in this, but today, the point is, we're seeing Microsoft down the whole day, underperforming. That's the one that's had the strongest run in the past couple weeks. We're seeing Apple relatively flat. We're seeing Google, probably the weakest earnings report out of all of them, be the strongest. Why would that be the case? They were up on Meta's report, and if anything, they should be coming down to reverse the fact that they were up on Meta's report, because their report wasn't so strong, and they were down on that just the day before. So I still think the tech pullback is in play. However, the market has been incredibly strong, so we have to be cautious playing the downside on this, and we have to take lessons from what the market has done the past few weeks and use that to adjust our positioning so we can benefit from a possible mean reversion as we now conclude earnings and are largely out of potential upside catalysts. I get it. CPI can come in lighter than expected. We can experience a dip in yields on that possibly, but it could also go the other way. So we're not really going to talk about that because that is very much up in the air. It's pointless to try and figure that out. You can maybe try to get into some data, but it doesn't seem that always works. So we'll see what happens with that CPI report. That is a potential up or downside catalyst later this week. Either way, yields are ticking up higher today. It seems that credit is contracting, which is an interesting dichotomy, but notable nonetheless. That could possibly be because a company like Apple is trying to unload debt into the market to add additional liabilities onto their balance sheet to buy back their stock. So a lot of weird and interesting things going on. We are going to stick to the fundamentals. And that brings us to our next area of focus that we discuss a lot, being energy. Last week, we saw tremendous declines in energy. We've seen tremendous declines over the last month, really since the banking crisis, when people decided to start pricing in a catastrophic 08 style recession. However, as we've talked about in the past, this 08 style recession for oil is highly unlikely to happen. Highly unlikely to happen. Let's not forget, oil and gasoline demand is relatively inelastic. It's not perfectly inelastic. If you've taken economics classes, you know the difference between relatively and perfectly inelastic. It's not perfectly inelastic, but it is relatively inelastic. What does that mean? That means when there is a change in price, demand doesn't really fluctuate too much, and demand stays relatively stable. We even saw that in the 08-09 crisis. Yes, there was a tick down in oil, but it wasn't so dramatic. The problem with the oil situation in the 08-09 crisis, which everyone wants to compare this to, that's why when there's banking stress, there's massive oil decline, because they're going to the most recent compare besides COVID, but maybe they're even going to COVID, the 08-09 crisis. Prior to the 08-09 crisis, there was a boom in oil. Companies were investing tremendously. They weren't concerned about an EV future. George Bush was president. Drill, baby, drill. Wars in the Middle East. Everyone was oil, oil, oil. So when the 08-09 crisis happened, you had several years of heavy investment, and then you had a slight tick down instead of growth. And if you look at the 2007 year of oil consumption growth, it is a very large uptick over 2006. So you had a very bullish oil environment and oil production growth environment, and then you had a slight contraction. Most importantly, though, a decline in growth, and you had a short-term but very notable collapse in the price of oil. That is very different this time. Refinery output, for example, hasn't recovered to pre-COVID levels. Oil production It's right around there, but it hasn't been investing. Oil companies haven't really been investing in oil production. Additionally, there have been OPEC cuts. And not only have there been OPEC cuts, but U.S. rig counts were actually down last week. So that is something to note. Not tremendously. I believe it was only 4 rigs came offline from 592 to 588. But it shows you when there is a decline in the price of oil that companies feel is unjust in some way, there is some elasticity to their production. That's important. The supply and demand deficit seems to be in place. We have had a very interesting year so far this year. It's been honestly flat but volatile, right around the 70, 75-ish dollar range. Obviously, we've gone a little below. We've gone a little bit above 80. But it seems every time we have a banking crisis, we kind of develop thicker skin to that. And now we've been through 2 major bank crisis sell-offs. And I would be surprised but not shocked if there is another pullback. But look, we're recovering a lot in the price of oil in the last 2 days. That has to be noted. Clearly, it wasn't about supply and demand of the actual commodity. It was about traders, panic selling, and fear. And that's what it was. That's being reversed. It's being reversed for good reason because, like I said, not a lot of price elasticity. There's a lot of consumption. Consumption is strong. We're now getting into the seasonal driving period. And I'm not bearish on oil at all whatsoever. As a matter of fact, I think these are some of the best cash flowing businesses. Why? Because, like I said, unlike prior to the 07, 08 situation, these companies weren't investing so heavily in production. So that's why you can see a company like Exxon having record quarterly earnings despite the fall in the price of oil. That's why you can see refinery margins staying relatively strong relative to history despite the fall in oil. RBOB performing very strongly today. I expect that to continue as driving demand hasn't weakened. It's not something that's happened. That's a fear about the future, and that's been a fear all year pretty much, but it simply hasn't materialized yet. So it might materialize, but the impact of that is relatively muted. It always is. In every recession, yes, it occurs, but the average decline in the price of oil is 30% in a recession, and we've experienced that. And we've experienced artificial supply for the last 6 months or prior 6 months. So it's questionable if additional downside is going to occur. Let's not forget, we printed a bunch of money. General inflation has occurred. This is a company that produces a commodity that can adjust with inflation. And these companies are producing tremendous cash flow, trading at very low multiples, and have very, very generous capital return programs that are unmatched anywhere else in the market. Simple as that. So I like these businesses. I'm happy to own these businesses. Warren Buffett and Berkshire Hathaway are happy to own these businesses. They have roughly 3 times the S&P 500 exposure to these businesses. It's their second largest exposure, collectively energy, Oxy and Chevron, outside of Apple. So that should tell you something. They view Apple as a consumer staple type business, rather reliable, producing cash flow. Oil, obviously, more volatile, but similar dynamics. Demand, even in a recession, pretty steady. We don't have a major increase in production prior to this recession, if it comes, which it most likely will, but we don't have the same dynamics that we've had in past recessions. As a matter of fact, we actually have quite the opposite. We have companies tightening the belt, avoiding investing in production. For the most part, there is some investment in production, but let's not forget, oil demand is growing, and it's expected to grow for decades to come. Why is that? Because while the United States wants to invest in EVs and do all these kinds of things, which are noble things to do, and will probably be economic wins in the long run if you can decrease the price of energy, they require immense short-term capital investment. And a lot of these emerging markets view it as unfair that the United States want to impose their agenda on them. They want the cheap energy for their initial stages of growth, just like the United States had cheap energy, cheap capital investment required for its initial stages of growth. So oil demand is expected to peak in 2050. Let's not forget, a lot of these foreign countries have bigger populations than us. Over time, our used gasoline cars will go to these emerging market countries, which have rising middle classes. Car ownership is likely to go up, and those cars are going to stay on the market longer than is probably forecast. Why is that? Because the average age of a car continues to go up. I believe now it's 12 years. That is a long time, and foreign countries is probably even longer than that. That's the United States number. So these cars are becoming better and more reliable. It's questionable if you can buy a car for $5,000 in India and pay slightly more for gas over electricity. Why wouldn't you do that over paying $40,000 for a Tesla? Obviously, that price might come down in the future, but all forecasts, for the most part, all serious, reliable forecasts predict strong gasoline and oil demand for the foreseeable future, which is at least 2 decades. So, energy stocks, volatile. That should be a takeaway. That should be a given. There is no reward without risk. However, many of these stocks, obviously I'm excluding Exxon and Chevron, other stocks have pulled back tremendously, but cash flows and earnings have stayed strong, as well as capital return programs, very minimal, if any, cuts, and in many instances, increases. So, I like the sector. It's volatile. You got to stick with it if you're going to be in it. Just rest assured that these companies are producing cash in a very reliable manner. They are doing one thing and one thing only. They are pumping liquid gold out of the ground and selling it on the market. And the market needs this commodity. Needs it. So, that's today's video. We covered some stuff. Until tomorrow, peace out.